All right, in this lesson, we're going to be looking at a ratio analysis. We're actually going to be looking at the ratio analysis that has to do with gross profit percentage. So this is an important one, especially for retailers, because they want to maximize their gross profit percentages, because that will at least help them get to covering all of their other operating expenses. So let's take a look at gross profit analysis. So again, ratio analysis. Why are we doing ratio analysis? What is ratio analysis? Well, ratio analysis is a way to get a quick look at a different aspect of a company's financials. So instead of just looking at the number at what they are, let's look at the percentages. Let's look at some of the ratios and see if they make sense. And really, at the end of the day, we can take the ratios and we can do something called comparison. So by doing ratio analysis, one can compare the current results with the past or expected results, as well as other competitors. So if you really think about it, if we have a big company like Amazon, then we have a smaller company like Best Buy, how do you even compare them? Well, the way that we compare them is through ratios. So if the ratios are very much the same, then that is a good comparison. We can't necessarily compare maybe Best Buy sales to Amazon sales, because Amazon sales are so much larger than Best Buy. And again, I don't know if that's fact, but I'm pretty sure that is. I'm just saying that, okay? But I mean, Amazon probably sells more than Best Buy, so I'm assuming that that's correct. So, but how do you compare that if one's really big and one's really small? We use ratio analysis. So we're going to be looking at the gross profit percentage. The gross profit percentage kind of tells us that after we pay for the goods we sell, how much is left for operating expenses and profit. So remember that gross profit is revenues minus cost of goods sold equals gross profit. That gross profit is what we use to pay for everything else that we have to pay for, operating expenses and our profit. Operating expenses are basically every other expense necessary to actually sell the product. So it doesn't actually include the product itself, because we're going to take that out at the very top. So how much did we earn after we paid for the product of each dollar we take in? So the equation for the gross profit percentage looks something like this. We're going to take 100 times, and then here's the meat of the equation, net sales minus cost of goods sold. So net sales, if you remember, we did an example where we got all the way from 250,000 down to net sales. That net sales is what we're going to throw in there. We're not going to put the 250, the gross sales. We're going to do it after returns, allowances, and sales discounts. So net sales minus cost of goods sold, and we're going to divide that by the net sales itself. So the multiplying by 100 gets it to a percentage, okay? So that's what we're trying to get to. Otherwise, it'll give you a decimal, and it wouldn't look correct. So by multiplying that answer by 100, we're actually getting the percentage that we want, okay? So the higher the gross profit percentage, the better. So if we're trying to interpret the results here, the higher the gross profit, the better. However, just because it's high or just because it's low doesn't mean that it's good or bad. We need to compare our results with past results as well as the industry. So for instance, a company like Facebook or Twitter is going to have maybe a 30, 40, maybe even 50. Actually, they probably have more like 70, 80% gross profit margin versus a company like a grocery store that might only have 20 or 30%. Why? Because their cost of goods sold are so high, and it's really a low margin game when it comes to selling those products, okay? Because everybody needs them and everybody's price sensitive because there's a lot of substitutions there. So we want to compare our results as a company to the industry or like competitors, not unlike competitors, because those competitors won't give us a good idea of whether we're doing good or we're doing bad. So to do this, we're going to use a company called Best Buy. So in front of you, you got a consolidated statement of earnings. All you need to know is that consolidated statement of earnings also means the income statement. So this is the income statement for Best Buy. And in their income statement, we have revenues, cost of goods sold, and gross profit. And really, that's all we need at the end of the day. So this box right up here. So we know that to calculate gross profit, we're going to take net sales. So net sales would be revenue. So 42 billion 879 million. How do I know it's billion? Because it says up here everything is in millions. So a 9, if they just put 9, that would be 9 million. So they've got 42,879. That would mean 42,879 million dollars. So 42,879 million minus our cost of goods sold. Our cost of goods sold is 32,918 million, and we're going to divide it by our net sales. In this case, our net sales would be 42,879 million, and we're going to multiply that by 100. When we do that, you should get something like 23.23%. So what does that mean? Well, this means that for every $1 that Best Buy brings in, they will have a gross profit of 23 cents or 23.23 cents. That means their operating expenses and profit have to equal 23.23 cents. So 23 cents of every dollar goes to operating expenses and profit. Now we can see here, if we kind of just walk our way down, they have a net earnings of $1,464 million. So they are able to squeeze a small profit. As you can see, it is profitable, but they are bringing in $42 billion to only make $1.5 billion. A majority of it is in cost of goods sold, the cost of the products that they bought from their vendors in order to sell to me and you. So there are some other things here that are a little bit more advanced. We won't really talk about them here, but those are things that happen like gain on sale of investment income, and interest expense. But those are another topic for another day. So that is kind of where we are. Gross profit percentage for Best Buy for this year would be 23% or 23.23. So hope you enjoyed this walkthrough of ratio analysis of the gross profit percentage, and we will see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.